So you talk a little bit about that.
Mhm. Yeah. So because they're minors, the parent or the adult is always going to be the owner of the plan until they decide to give it or transfer the ownership to the child. And people like that feature of the plan because unlike some of the other investment accounts a UTMA or a UGMA, these custodial investment accounts, those accounts belong to the child when they turn the age of majority. Right here in Georgia is 21, and so they lose control of those investment accounts. But on the insurance, the parent or the grandparent remain the owner of the policy until they choose to transfer it over to the minor. And so I have one client there. We talked about their goals and the strategy. So what they want to do, they love real estate, and so they put a plan on their child. I think she's about 3 years old, and we did the math to figure out how much we need to fund it for them to have 50K in cash value when they're 18. Okay, and what she's going to do is she's going to take a portion of that 50K, look at the rental markets, most likely in St. Louis or Ohio, buy a home. She's not paying into it, but she then wants to use the cash flow from the rental properties to pay the premiums on the insurance plan so that it continues to build over time, right? And there's no money coming out of the pocket. The real cash value is going to grow, and so next year or the year after, when she turns 20, recycle it and continue to do that. So there's again a lot of different ways that you can structure it, but that's just kind of one example of leveraging the equity inside of a plan to build other assets. In this case,
When I say I love
real
that,
estate.
well, I love that. So how much are
Mhm.
they paying a month to pay into the 3-year-olds?
I think they were doing, yeah, I think they were doing about 500 a month. And we did what we call overfunding, essentially where you have the minimum amount required. So for the insurance premium, but then you pay a little bit extra to build up the cash value faster. But it also provides a little bit of flexibility to where if a month or two you can't put in 500, you can dial it back to the minimum and still be okay. So
That's
she
good.
liked that more than just a normal investment account because it's a lot of flexibility.
Yeah, so the plan was to
Hmm.
leave it alone for 18 years, for 18 years. And then when the baby turned 18 years old, buy her a rental property. She'll have $50,000 worth of cash. What would she do with the 50,000? Would she use that 50,000 to buy the rental property?
Yeah, as a down payment,
Okay, down payment.
depending
And then
on depending on the type of property, but in those markets, down payment.
okay, so down payment and then take the mortgage that's due and use no. Okay, help me. Oh, she's going to take the tenant cash flow to continue to pay into the premium.
Yes,
Yeah, I like it.
yes,
I like it. I
yep.
like it. Ah, I like it.
Hmm.
I like it. I mean, it's all about
Yeah.
strategy.
Hmm.
Now, imagine if she had, 4 children doing that. She might say, "Hey, I can't do, you know, 500 on 4 children. Maybe it's $100 each on four. The fifth we do 500." I mean, that's the beautiful thing about it. You can just get real creative, but now that's like the bank of Odom, or the bank of Grind, or the bank of, Garland, whoever's on here tonight. You're now creating your own bank, and you keep doing it, and you look up and you're like, wow, we really ended up building a really nice situation. Okay, so just a quick review as we get ready to wrap the call, Sean. I'm glad you came on tonight. So whole life is going to be a little bit more conservative. Index universal life is going to be a little bit more aggressive in your investing. Do you have one that you feel like pays out better for those that want to use it as retirement?
Yeah. I if you want something that pays out more aggressive, go with the universal life. IULs, index universal life, variable universal life, some universal life plans tend to have a greater cash value growth potential. Okay. And so a lot of times I tell people, if you have, a 5-year runway to where you don't necessarily want to tap into it, if you kind of want to use it pretty quickly, or if you're risk averse, then the whole life would be kind of a safer route to go. But if you want something that give you some good growth and you kind of understand how investing works in the case, it really kind of depends on a lot of factors. But typically, if you think about this for a second, the traditional stock market, you will make money. You just have to have time in the market for it to work out in your favor. So if you got time, some good options, and then there's some protection mechanisms on some plans as well with caps and floors that you can leverage also.
Absolutely. And then of course, we could talk about, for some of you all that are, CEOs, you might want to do some key man policies as well, things like that. So listen, Sean, thanks so much for jumping on here. Y'all already know we dropping tea on here all the time, so you don't want to miss it. In the mornings, we got prayer. In the evenings, we got wealth. I mean, listen, it's a win-win. I want to encourage you, go ahead and get your tickets right now to the Monopoly in Real Life Conference next week, August 31st, September 1st in Detroit. It will not disappoint. We got some of the top industry experts that are coming in, and not just talking about something that they do every now and again. We don't have like no part-timers. Everybody that we got on the platform are specialists. This is like what they do in real life for real life. And so we want to encourage you to plug in, tap in. I know that's a holiday weekend, but that's a perfect weekend for you to say, let me get serious. Or everybody else barbecuing and eating, you're going to be at the Monopoly Real Life Conference getting game on what your next strategy is. Because we literally got like 5.5, maybe 5 months, like in 2 weeks left in 2024. And I'm sure if you're on here, it's because you're attracted to the scale up, you're attracted to increase, you're attracted to expansion. You're not following me, you're not listening to this because you're trying to be regular, right? There takes a degree of obsession to really be successful in anything. And so you have a lot of people that are obsessed with what we do, and it's going to really be able to help you get to the next level. So Sean, thanks so much for coming on here tonight, brother, and dropping that tea. Get your tickets right now, monopolyconference.com. It's going to really set you up. And the sooner you start, the better. Let me ask you this last question before we get ready to wrap. For somebody who's saying, listen, I don't have $500 a month, what's the minimum would you say somebody should be thinking about that they need to start? Because I know a lot of times people are like, okay, I'm going to wait till, little Johnny graduate, or I'm going to wait till this. But I really feel like when it comes to some of these baseline, foundational wealth principles, what would you say? Bottom line, you need to tell yourself, I'm paying into this policy every month. What's the minimum they should really be thinking about?
I would say minimum probably $50, right? I'm a firm believer of something is better than nothing, right? And so what we hear all the time is, I'm gonna wait, like you said, I'm gonna wait until I get my money together. I'm gonna wait until I pay off some debt. I'm gonna wait until you do those things, which is fine. But insurance is one of those things that depend on your age and your health. Okay. And so you wait next year, we don't know what your health is going to be like. We know you're going to get 1 year older, right? But we don't know what your health is going to be. And so if you're really serious about building wealth, if you're looking for a way to transfer wealth, I would say start with something. And if you can do 50, great. If you can do more, that's even better, right? But I would say start with something.